Well, there's been a lot of talk lately about silver stackers being right all along. And honestly, this is one of those videos where we have to separate celebration from confusion. Because yes, the people who stayed bullish on silver were much closer than a lot of the cautious voices out there. But if we're going to give them credit, we also need to clean up the timeline, clean up the numbers, and make sure we are not building a victory lap on sloppy information. So in this video, we are going to take the emotion, the price action, the history, and the current setup, and we are going to piece it together in a way that actually makes sense. Today is Saturday, May 2nd, New York time. Drop a comment and tell me what day and date you are watching from, because silver moves fast and context matters. And before we get into it, if you value this kind of content, support by subscribing and comment, Our John AG. That is it. Short, simple, and it helps the channel more than you know. So here's the confession. A year ago, if somebody told me silver was about to go from the low 30s to a place where people would seriously talk about triple-digit silver, I probably would have said, okay, maybe someday, but not like that. Not that fast. Not with that kind of violence. And yet, here we are. Now, that does not mean every wild prediction was wise. It does not mean every chart with a rocket emoji was analysis. And it definitely does not mean anyone should confuse a price spike with a permanent new reality. But it does mean something important. The bullish stackers saw a pressure building in silver that many people underestimated. So, let us start with the basic picture. Around this time last year, silver was still sitting near the low 30s. That means $100 could get you roughly 3 spot ounces before premiums, taxes, shipping, and all the other little frictions that show up when you actually buy physical metal. Today, with silver moving around the mid-70s recently, that same $100 looks completely different. It does not stretch the same way. It does not feel the same way. And if you are buying coins instead of just thinking in spot price terms, the difference is even more obvious. That alone should stop people from saying nothing has happened, because something has happened. A very big thing has happened. But here is where we have to slow down. The story was not that silver was already near 100 in early May last year. It was not. The better timeline is this. Silver started from a much lower base, climbed through the year, got increasingly crowded, then exploded into a January spike that pushed futures into the 120 area before the market snapped back. That difference matters. It matters because if you get the timing wrong, you misunderstand the whole move. So, was that January move a bubble? Maybe. But I would be careful with that word. A bubble suggests the move was just nonsense, and I do not think that is fair. What I think happened is simpler. A real structural story met a very emotional market. Tight supply, industrial demand, investment demand, geopolitical fear, dollar concerns, and momentum buyers all showed up at the same party. And when everyone tries to squeeze through the same door at once, price does not walk. It jumps. Then, when the door opens the other way, it does not gently drift down either. It falls. That is silver. And if you are new to silver, this is where you need to understand something. Silver is not gold with a smaller price tag. It has a precious metal personality and an industrial metal personality. Sometimes it trades like fear. Sometimes it trades like copper. Sometimes it trades like a monetary asset. Sometimes it trades like a factory input. And sometimes, especially when markets get emotional, it trades like all of those things at once. Now recently, silver has been hovering around an area that would have sounded almost ridiculous not long ago. And yet, people are bored. People are frustrated. People say, well, it is not doing anything. Okay, but compared to what? Compared to the January blow-off? Sure, it is quieter. Compared to last year's starting point, this is still a completely different price neighborhood. That is the mental trap. After a huge move, the new level starts to feel normal very quickly. Human beings do this with everything. The first time silver breaks into a new zone, everybody is wide awake. Then, after a few weeks, that same zone becomes boring. And then people forget how impossible it sounded before it happened. So, if you were stacking before this move, I think you have to take a step back. Do not just stare at the last candle. Look at the whole staircase. Your silver did more than sit there. It repriced. It forced the market to take it seriously. It reminded people that physical metal can sleep for a long time and then suddenly wake up in a way that makes the past look cheap. That does not mean you brag. It means you learn. And it also means we need to be honest with the people who bought late. Because if somebody bought near the top, they are not feeling like a genius right now. They are looking at the stack and thinking, did I mess up? And the answer is, maybe on timing, but not necessarily on the entire thesis. There is a big difference between buying a good asset badly and buying a bad asset. If you chase the spike, yes, that hurts. If you bought physical silver when premiums were hot, that hurts even more. But this is why cost basis matters. This is why pacing matters. This is why nobody should take a year of rising prices and turn it into permission to go all in at the worst possible second. And this is also where I want to push back on one idea that gets repeated too easily. People say silver stackers were right, therefore silver can only go higher. No, that is not how markets work. Being right about the last move does not give you ownership of the next one. Silver can be structurally strong and still correct. Silver can be in deficit and still punish late buyers. Silver can have a long-term bullish setup and still spend months doing absolutely nothing. Based on recently published numbers, the global silver market is still expected to remain tight, with another annual deficit projected. That is important. But a deficit is not a magic button. It does not mean price goes up every Tuesday. It means the background pressure is there. It means inventories and available supply matter. It means industrial users, investors, and refiners are all competing inside a market that does not create new mine supply overnight. And mine supply is not like flipping a light switch. You do not wake up, decide silver is expensive, and suddenly produce a new billion ounces. Mines take years, permits take years, capital spending takes years, grades decline, costs rise. Some silver comes as a byproduct from mining other metals, which means even higher silver prices do not always bring a direct supply response. On the demand side, the story is also changing. Solar, electronics, vehicles, data centers, and high-voltage equipment all keep silver in the conversation. Now, manufacturers will try to use less when prices rise. They always do. That is called thrifting. And at these prices, you should expect more of it. But using less is not the same thing as using none. Silver has properties that are difficult to replace cleanly, especially when performance matters. That is the part nobody wants to hear, but it is the part that saves people. Because if your thesis requires silver to go straight up, your thesis is too fragile. If your plan only works if every dip is fake and every rally is permanent, you do not have a plan. You have excitement. And excitement is useful for clicking a buy button, but it is terrible for managing money. Well, first, recognize the win without becoming reckless. If you were early, you were early. That matters. You accepted boredom before the crowd accepted urgency. You bought when the market was not giving you applause. You held through dead periods, jokes, sideways charts, and people telling you nothing was happening. And now the market has at least partially validated that patience. Second, do not let one historic spike rewrite your expectations. The January move showed what is possible under stress. It did not prove that the market must live there tomorrow. The more useful question is not, can silver touch triple digits again? Of course it can under the right conditions. The better question is, can silver build a durable base above the old range? Because if silver spends enough time holding a higher zone, then the conversation changes. Dealers adjust. Investors adjust. Industrial buyers adjust. Miners adjust their assumptions. New stackers stop thinking of the old price as normal. And slowly, what once looked extreme starts becoming the reference point. We need more time. We need to see how silver behaves when the dollar firms up. We need to see what happens if real yields stay stubborn. We need to see whether investment demand cools off or comes back. We need to see how physical premiums behave when panic is not driving the order book. And we need to see if industrial buyers keep absorbing metal even while complaining about price. Now, let us talk about the dollar for a second, because this is one of the biggest pieces. Silver is quoted in dollars for most of the people watching this, so when the dollar strengthens, metals can get pressure. When rate cut hopes fade, metals can get pressure. When the central bank sounds less friendly than traders hoped, metals can get pressure. Recent policy updates show rates are still being held in a range that keeps the opportunity cost conversation alive. That is not the whole silver story, but it is part of the short-term tug of war. That balance is important. If you are successful, share your success story in the comments so others can stay motivated. And while you are there, tell me this. Did you start stacking before the big move, during the big move, or after the correction? That answer changes how you see everything. That is why dollar cost averaging still makes sense for a lot of people. Not blindly, not mechanically if premiums are ridiculous, but as a discipline. Buying in pieces keeps one bad day from defining your whole stack. Buying more when the market is calm and less when everyone is screaming can save you from becoming exit liquidity for somebody else's excitement. That may be the most underrated lesson from this whole move. There are times to buy, there are times to hold, there are times to watch. If you already have a core stack, you do not have to prove your conviction every week by adding at any price. Conviction is not the same thing as impatience. So putting this all together, were silver stackers right? In the big picture, yes, many of them were. They saw that silver was too ignored, too useful, too tight, and too cheap relative to the risks building around it. But were all the extreme claims right? No. Were all the timelines clean? No. Was every spike sustainable? Also no. You can be right on the direction and still wrong on the timing. You can be right on the asset and still wrong on the entry. You can be right about the structural deficit and still get shaken out by volatility. Silver does not reward sloppy thinking just because the long-term story is strong. So celebrate, but stay sober. Appreciate the move, but respect the risk. Keep the big picture, but do not ignore the math in front of you. And if you ever feel bored because silver is only sitting in the mid-70s, go back and remember what the low 30s felt like. Remember how crazy today's price would have sounded before it became normal. Subscribe if you want more clear, no-hype silver breakdowns like this, short and simple. And finally, this is for education and perspective only. I am not your financial advisor. I do not know your bills, your timeline, your risk tolerance, or your stack. Use this as a starting point for thinking clearly, not as permission to buy, sell, panic, or chase.